The AI tech trade is officially fracturing, but the smart money isn't hiding in cash. They are aggressively moving into a new hard asset playbook. While the Nasdaq crashed over 4% this week over semiconductor earnings, physical energy, broad commodities, and Bitcoin quietly absorbed billions in institutional capital. Driven by a major geopolitical supply shock in the Middle East, commodities are being aggressively repriced, and for the first time, Bitcoin is completely decoupling from the tech sector to act as a pure digital commodity safe haven. Today I'm going to break down this historic macro rotation and show you the institutional footprint and look at the Ichimoku charts to plan our next trades. The Nasdaq dropped by a -4%, and we've had a weekly close below the conversion line, with the baseline marking the next level of support, indicating we might see some short-term bearishness. However, that does not mean the tech trade is over, or that we are entering bear market territory, as the equal weighted Russell is still bullish, and while we've had a negative close of 0.43%, it shows most of the bearishness in the markets came from tech, so the average stock had an average week again, with price being above the conversion line and the baseline, and lagging span being above price, and the cloud being bullish. With the baseline and the conversion line flattening out, it means we can anticipate some ranging, or for price to retest the conversion line or even the baseline. And we don't have enough trading data to show the Ichimoku cloud, but DRAM, the memory ETF, dropped by over 16%, with the top holdings being Samsung, Micron, and SK Hynix, with SK Hynix looking to have closed below the baseline on the weekly. The next area of support could be the boundary of the cloud, and on the daily we've got price in the cloud, which is the turbulent zone. Future cloud is thinning out, price is below the conversion line and the baseline, and lagging span is below price. However, we haven't dipped below the neckline just yet, and this was covered earlier in the week, where the stock plummeted 15% in Korea, and SK Hynix seems to have dropped, as analysts predict SK Hynix's second quarter operating profit will slightly miss market expectations. A researcher at Korea Investment and Securities estimated in a report on the 13th that SK Hynix's consolidated revenue for the second quarter would reach 80.9 trillion, with an operating profit of 60.4 trillion Korean won. Though this represents a 54% and 61% quarter-on-quarter increase, respectively, it falls approximately 8% of the market consensus of 65 trillion Korean won. And this is due to the memory industry shifting toward 3 to 5 year long-term supply contracts and corporate value depending on how long high profitability can be sustained rather than quarterly ASP growth. ASML also reported this week, with the CEO even saying our second quarter total net sales were 9.3 billion and gross margin came in at 54%, both above guidance, which again did not seem to reflect in the markets, even though ASML have a share buyback program and dividend, which takes us back to SK Hynix leading the market, and this all eventually trickled down to the semiconductor index, which is now closed below the neckline, with roughly a 20% drop projected, based on its 1-to-1 move. Price also closed below the conversion line on the weekly, with the baseline not being that far below, so there could just be short-term consolidation here too. Every other day, there seems to be a catalyst driving up the XLE as well as oil. XLE is starting to look a little more bullish. Looks like we're about to get a bullish cross here. However, price is still below cloud and the diagonal. We haven't had a bullish twist either, but it won't be good for the market if this does break out. I've also spotted BCI, PDBC, and HGER all catching a bid with significant volume. BCI had the largest relative volume, but price is still below the cloud, and the cloud is still bearish. And for HGER, we've had a cloud breakout, and some ways to go until we get to the target. The largest holdings is oil and gas, which always rises with uncertainty. It also looks like Bitcoin is being treated as a digital version of a commodity hedge, as we again have seen record volumes this week. This could be catalyst driven, as Bitcoin recovered towards 65,000 on Saturday after sliding alongside semiconductor and technology stocks, as the new Chinese artificial model and fading expectations for US crypto legislation pressured risk appetite. And the Genius Act, which regulates stablecoins, passed both chambers of Congress with strong bipartisan backing. Members understand digital assets aren't disappearing and recognize it's time to act. Other countries are moving aggressively, and global capital and innovation will flow to markets with clear rules. I've been looking at the relative pair charts for Bitcoin and Nasdaq. If Bitcoin outperforms, it goes up. If Nasdaq outperforms, it goes down. And dating back to 2012, we can see as soon as we have a Kumo cloud breakout, there is massive outperformance relative to the Nasdaq, something that we have seen time and time again, as you can see marked by the yellow circles on this chart, with the only false signal really being in 2019. And by overlaying the actual chart for the Nasdaq, represented by this green line here, you can see for each weekly breakout, the Nasdaq was already in an uptrend, and Bitcoin simply just outperformed. And it seems to me that it's somewhere around this point where the weekly breakdown was, that the decoupling had first started, maybe even somewhere here, as the Nasdaq has gone up here, but Bitcoin continued its downtrend. I say all that to say that while Bitcoin is still below the cloud and the target is still bearish, the heavy institutional accumulation is suggesting otherwise, with BlackRock even suggesting that Bitcoin is a unique diversifier, suggesting that Bitcoin has risk and return drivers that are distinct from traditional asset classes and that are fundamentally uncorrelated on any long-term basis, with them expanding on it slightly within the paper. Bitcoin reflects little fundamental exposure to other macro variables, explaining its long-term average correlation with equities and other risk assets. While there have been brief periods where Bitcoin has seen its correlation spike, particularly around episodes of sudden shifts in US dollar real interest rates or liquidity, these episodes have been short-term in nature and have failed to produce a clear long-term statistically significant correlation relationship. So I do wonder whether we are seeing the first signs of that. If you found any value in this video, please like, comment, share and subscribe.